Like any forex strategy, if you want to trade supply and demand correctly, there are a few key rules you need to follow. Well, maybe not rules, more like some do's and don'ts. See, so much misinformation has been spread about supply and demand over the years that nowadays, to actually trade the zones properly, you need to understand what is and isn't true about the strategy, and this especially applies to rules. If you search the web, you'll find many supply and demand gurus and experts stating their rules for trading the zones. However, many, if not all, of these rules are wrong in some way, either because they aren't real or just don't make any sense. So to trade the zones, you need to know what these are and what the correct rules are. That's what I'm going to show you in this video. There are 3 rules in total, with a few more guidelines which we'll look at in my 3 factors video in the next section. Here's rule number 1. Supply and demand and support and resistance have a lot in common. However, one key way zones differ from levels is that they're only valid for one reversal. Price can't return and reverse multiple times, like with support and resistance levels. Supply and demand zones are a one-time use only. Not 2 times, not 3 times, and not 4 times. One time only. Once price returns and reverses from a zone, that zone is dead, it has no power left. Price may still return and reverse in the future, but it won't be the zone causing the reversal, it'll be something else, some other technical factor. So why don't zones generate multiple reversals like support and resistance levels do? The answer lies in how zones form in the first place, from the banks entering their positions. Price returns to supply and demand zones because the banks haven't been able to execute their entire position. Not enough opposing traders were buying or selling at the same time, so they couldn't buy or sell the full amount they wanted. The banks have still got trades left to place, profits to take off, or open trades to close out. To get these remaining positions executed, the banks must manipulate the market to bring price back to where they entered their initial positions, which is the supply or demand zone. That'll cause more traders to enter against them and allow the banks to get their remaining positions placed, at which point price will reverse from the zone. But here's the thing, if the banks bring price back to a zone to get their remaining positions placed, they'll only do so once. They won't bring it back multiple times because there's no point. Think about it. If you plan to bring price back the first time, you obviously wait until enough traders are buying or selling against you, right? You don't bring it back and then say, whoops, still got to find another 300 sellers from somewhere, better bring price back a second time, guys. You calculate it so that the first return generates enough buyers or sellers to get all your positions placed. So it doesn't make sense for supply and demand zones to work multiple times, because why would the banks bring price back over and over again? Now, does that mean price won't reverse from some zones more than once? No, of course not. However, it's not the zone causing the reversal, but something else, like a news release for instance. News comes out, price reverses from the zone. It's not the zone causing the reversal, it's a news release. They just happen to occur at the same time. Some supply and demand zones will also generate multiple reversals due to being part of a structure, usually consolidations. These zones, which form at the base and top of consolidations, will often cause price to reverse 2 or 3 times. But again, it's not because the zone itself is causing the reversal, it's simply due to the consolidation, price moving back and forth within the range. Old zones causing reversals is one of the key rules found in normal supply and demand teachings, yet like so much of the education out there, it's one that isn't true and really doesn't make much sense. Old supply and demand zones do not, I repeat, do not cause reversals, okay? They look like they do, but in reality it's just an illusion created by the charts. It's not the zone causing a reversal, but something else unrelated. So why don't old zones cause reversals? The answer is because the banks, which cause price to return and reverse from zones, don't wait a long time to get their remaining positions placed at the zone. They bring price back quickly to get their positions placed ASAP. And if you think about it, it makes perfect sense. If you're a bank who has another huge buy trade to place at a demand zone, do you want price to return to that zone quickly or 3 months after it's formed? And let's say this is a 1 hour zone too, obviously long-term traders will wait longer. You want it to return quickly, right? Not months after you first entered the trade that created the demand zone. Because if you wait a long time, what could happen? What's the big danger for you and your trades? The danger is the price may drastically change. A news event or disaster could change the whole market, invalidating your reason for entering the buy trade in the first place. So you want to place the buy trade as fast as possible. That way you avoid the risk from unpredictable events. Let me guess. Your next question is probably, well, why does it look like price reverses from old supply and demand zones then? Again, this is a simple explanation. Price looks like it reverses from old zones because other technical factors happen to occur on or at the zone. One of the most common of these are big round numbers. Prices ending in 3 zeros, 4 zeros or 500. Here's an old supply zone on USD Japan. As you can see, price reverses from this zone, even though it's taken 6 months, an eternity in market terms, to actually return. Now, most supply and demand teachers would point to this as confirming old zones can cause reversals, because on the face of it, the zone is what caused price to turn and reverse here. However, look at the prices on the right. What do we have? A big round number. The 110 level is located just below this demand zone, and price actually only reverses after hitting this number. So really, it wasn't the zone behind this reversal, it was the round number. The zone just happened to fall in line with this number, that's why price reversed. Big round numbers are just one possible cause too. Support and resistance levels, Fibonacci retracements, news events and other factors can all make it seem like price reverses from old zones. But again, it's not the zone behind the reversal, it's these factors instead. Here's a quick list of how long it should take price to return to a supply demand zone based on what time frame it's formed on. On to rule 3 now. Our final rule is another mistruth you'll hear many supply and demand teachers and gurus say, and again, one that doesn't make much sense. Supply and demand gurus will often tell you that how price moves into the zone plays a large part in whether or not price will end up reversing. For example, if price enters the zone in a strong fashion, like you see here with big bullish candles forming, that's a sign the zone will fail because the momentum is too high, it's too much force for the zone to hold. Like so much in Forex, this sounds like it makes sense. However, just like the previous rules, it's not actually true. The move into the zone has no effect on whether price ends up reversing, none. It might play a small part in where price reverses in the zone, top, bottom or middle, but it has zero effect on if it reverses, okay? The move into the zone doesn't matter because it's not the banks causing the move, it's retail traders. It has no real strength. It may look strong on the surface, but without the banks being involved, it's just an illusion, just like the other rules. Remember, the banks can't buy when price is rising or sell when it's falling because they need opposing traders. Buy as if they want to sell, sell as if they want to buy. So the move into the zone isn't from the banks buying. It can't be because most of the traders are buying. There are no sellers for the banks. It's retail traders buying, partly due to the rise and possibly due to economic news. It doesn't matter if the move is strong with big candles forming or even weak with tiny candles forming. The banks aren't behind the move. So however strong or weak it may appear, the reality is it has no real power and so can't be considered as a strong move into the zone. So those are the 3 key rules you should always follow when trading supply and demand. There are others which are more guidelines rather than stone cold rules, but these are the 3 key ones you must follow. Write these down somewhere or make a note of them. They may seem simple, but believe me, they'll save you a ton of time, not to mention a lot of money.